Well, good morning. It's my pleasure to welcome you to this second ECB Forum on Banking Supervision. When I spoke at the forum in 2015, European banking supervision had only been in operation for 1 year. Much had been achieved in that time, not least, you may remember, the comprehensive assessment of bank balance sheets, but in many ways the single supervisor was still untested. We saw European banking supervision as having two main objectives: to reduce bank-specific risks through tough and forward-looking supervision, and to reduce country-specific risks in the banking sector by applying those same high standards across the whole of the euro area. Now, 3 years on, we can begin to take stock of what has been accomplished. What is clear is that European supervision has been instrumental in building a stronger and more resilient banking sector. The country in which a bank is located has also become a less important factor in how its credit risk is perceived. These two achievements have been crucial complement for our monetary policy. Since banks are the main channel of financial intermediation in the euro area, a well-integrated financial sector with sound banks has helped transmit our policy impulses more evenly across the euro area. And it has allowed us to pursue an accommodative policy for as long as necessary without building up significant financial stability risks. There is no doubt that building European supervision has been a remarkable undertaking. Today, we have about 900 supervisory staff working at the ECB, who together with 4,700 national supervisors directly oversee around 22 trillion euro in assets, representing about 200% of the euro area GDP. But more important than its scale have been the changes the single supervisor has prompted in the conduct of supervision. It has broken with the past in a single but fundamental way. That is, it has brought about a more uniform approach in how banks are supervised, leading to a more resilient banking sector overall. The key catalyst for this change, alongside with new European Union regulations, of course, has been the harmonization of the supervisory review and evaluation process, so-called SREP. This harmonization has allowed supervisors to converge towards common benchmarks in how they assess risks, and it has helped them to be consistent in how their risk assessments are then linked to supervisory capital add-ons and to other measures. To illustrate the difference this has made, in 2014, the correlation between SREP scores and Pillar 2 capital requirements was 26% in euro area. In 2016, it's 76%. European supervision has therefore resulted in a substantial strengthening of shock-absorbing capacity within the sector. The total capital ratio of banks supervised by the ECB has increased by more than 170 basis points since early 2015. The quality of capital has gone up as well. The high loss-absorbing component, CET1, now makes up the largest share of total capital of euro area banks. Specific weaknesses are also now being addressed in their entirety across the euro area. Currently, the most important issue here is tackling non-performing loans. We all know the damage that persistently high levels of NPLs can do to banks' health and credit growth. Internal ECB analysis shows that over recent years, banks with high stocks of NPLs have consistently lent less than banks with better credit quality, therefore providing less support to firms and households. And though NPL levels have been coming down for significant institutions from around 7.5% in early 2015 to 5.5% now, the problem isn't yet solved. Many banks still lack the ability to absorb large losses, as their ratio of bad loans to capital and provisions remains high. We therefore need a joint effort by banks, supervisors, regulators, and national authorities to address this issue in an orderly manner. First and foremost, by creating an environment where NPLs can be effectively managed and efficiently disposed of. Importantly, the development of European supervision has not only reduced the risk of individual banks failing, it has also, as we hoped, had some success in reducing the importance of location in the perceptions of bank risks, because single, rigorous supervision is an essential precondition for the other pillars of the banking union that more decisively sever the bank-sovereign links. Indeed, looking at the largest banks for which we have data available, the correlation between bank credit default swaps and those of sovereigns is now considerably weaker than at the height of the euro area crisis. Still, there is no room for complacency, since these improvements are likely to have been driven in part by the improved economic situation. It is therefore crucial that further reforms to de-link banks from sovereigns do not lose steam, notably completing the other pillars of the banking union. All these supervisory efforts have not only produced a more robust banking sector, they've also provided crucial support for our monetary policy, since we entered a new easing phase in mid-2014. This support has come from two main sources. First, stronger supervision has improved the transmission of our policy impulses through banks. There's now plenty of evidence to suggest that the level of bank capital is a key variable in how banks lend during downturns, and hence also for monetary policy transmission. It is therefore no surprise that the improved health of the banking sector, coupled with our credit easing measures, has coincided with a marked improvement in the transmission process. Previous asymmetries in bank lending rates across the euro area have now largely been reversed. The cost of bank borrowing has stabilized at historical lows everywhere in the euro area, and so its dispersion, the dispersion of lending rates across countries, and also funding rates. We can now say that the pass-through from our past policy measures to lending rates is near completion. The decline in lending rates has been particularly noticeable for small loans in vulnerable countries, which are a proxy for the financing conditions faced by SMEs. SMEs are, of course, highly dependent on well-functioning banks, as their options are limited when it comes to accessing market finance. For these small loans, the spread between vulnerable and more resilient countries has now narrowed to a record low of 5 basis points. This more even credit pricing across countries and firms has in turn been crucial to the broadening of economic and employment recovery, not least because SMEs represent 60% of euro area value added and employ 70% of labor force. The second way in which stronger supervision has supported our monetary policy is by helping contain any financial stability risk that may emerge during a long period of low rates. One channel through which such risks can appear is the search for yield effects. Low rates can in principle induce banks into making lower quality loans, leading to higher loan losses. But with a strong supervisor ensuring well-capitalized banks, the quality of lending tends to be higher. This is confirmed by a major study looking at loan-level data in Spain, which finds that when overnight rates fall, highly capitalized banks grant fewer loan applications to risky firms than lowly capitalized banks and have fewer loan defaults. With a more resilient banking sector in the euro area, we've seen this more positive picture develop. Credit risk exposures in banks' loan books have declined as monetary policy has eased. Default rates have fallen, and forward-looking measures also suggest a decline in credit risk. This has, of course, been driven by improvements in credit quality as the macroeconomic situation has also improved. But it may also reflect the role of higher capital in resolving agency problems. The more a bank is capitalized, the more its owners stand to lose if borrowers default and cause losses. So the more equity a bank holds, the greater its incentive to make higher quality loans. Other financial stability issues associated with low rates have also not materialized, thanks in part to the stronger supervisory framework. At euro area level, we currently see no signs of credit-fueled housing bubbles, which are at the root of most serious financial crises. Since 2016, bank lending for house purchases has risen on average by 2.9% per year, well below the growth rates of up to 12% recorded in the run-up to the crisis. Some local pockets of risk, of course, have emerged, but both supervisors and macroprudential authorities are actively taking steps to counter them. We've also seen little evidence that negative interest rates are undermining bank profitability, an issue which has caused a lot of concern. This would pose a financial stability risk to the extent that it hinders banks from building up capital through retained earnings and makes raising market equity too expensive. It would also affect monetary transmission for the same reasons. In fact, net interest income has remained quite stable over the past 2 years, as overnight rates have drifted lower. And thanks to gains in other income components, banks' return on equity has been rising and is converging towards their cost of equity. For the banks under ECB supervision, return on equity has risen from 4.4% at the end of 2015 to 7.1% at the start of this year. This neutral impact of negative rates is largely due to the general equilibrium effects of monetary policy, that effects that we've explained many times. When policy is accommodative, the main components of profitability largely offset each other, since the positive impact of a stronger economy on loan loss provisions largely cancels out any negative effect on net interest income. For some banks, however, these negative effects may be larger than for others. This is where strong supervision is again crucial. As part of its SREP, ECB banking supervision carries out detailed comparative assessments of banks' business models, which feed into the ongoing supervisory dialogue between the supervisory teams and banks. This process is not prescriptive, but it helps bring to light important issues, such as the sustainability of banks' business models in a low-rate environment and their operating costs in comparison with their peers, which in some countries are indeed a contributing factor to low profitability. Now, let me conclude. We're now 3 years into the life of the European banking supervision, And the track record so far is encouraging. Though the single supervisor is still a young and developing institution, it has in many ways lived up to the high expectations that accompanied its founding. Rigorous and uniform supervision has led to higher levels of capital and a more resilient sector overall. The credit risk of banks is now less determined by the credit risk of their country of establishment. Let me just incidentally thank Madame Nouy and all the staff of the SSM for the fantastic work they've done in the last 3 years. It's things that if you go back with hindsight, it would have been unthinkable 3 years ago. So I think we all owe a debt of gratitude to them. Healthier banks have in turn helped transmit the ECB's accommodative monetary policy more evenly across the euro area, leading to a stronger and broader recovery. And the new supervisory framework has helped mitigate any financial stability risks that might have arisen as a result. In short, European supervision and European monetary policy have proven to complement each other well. It is an approach which confirms the synergies that can be reaped when the right policies are combined at euro area level. Thank you.
As we just...
I open a little bit
good.
water, just in case. Oh, sorry, I should have served you first.
Okay. Thank you very much. As we just heard from President Draghi, the ECB banking supervision is still a very young institution. As it started 3 years ago with a lot of public expectations, hand on heart, how many sleepless nights did you have so far?
I sleep very well, to be honest. I have always been sleeping very well, so
okay.
it's with my body and my nature.
Nothing changed. Congratulations.
Nothing changed.
Okay. Let me ask you another question on that. What lessons have you learned in that period of time? I guess you started 3 years ago and nothing were so perfect as it should be, maybe. So what did you see any mistakes in that way?
Well, first of all, I should say that it would never have happened like it happened, what we have managed to achieve, if we had been out of the ECB. Yes. ECB colleagues have been wonderful to support the small startup that we were when I started in the ECB 2 January 2014 with 2 assistants and an advisor, and we had to recruit about 1,000 people, including the support services, in a few months. We got an incredible support from everybody, so we had the feeling of being a tiny startup in a very powerful and credible incubator with a very good reputation.
And the question to you about mistakes in that 3 years?
Mistakes, well, we can always do things better, but, we are also, like a young institution, learning by doing to a pretty large extent. Because we have people coming from 19 different countries, well, even more, because all the members of the European Union can apply and have applied. We have all the European Union countries represented, but 19 different ways of doing supervision in the different euro area countries. So we started by deciding among all those practices where the best practices, and we use these best practices as the rule of the game for the SSM. So until we managed to harmonize according to these best practices, there were things that were not done perfectly. Today, we are still not doing everything perfectly. We had a good report from the European Commission for the work and achievements of the SSM, but they have noted that some areas have to be improved, and we will work on this needed improvement, obviously. Complacency is always a bad concept. We should never be satisfied of ourselves, and we want to always do better.
So in concrete sentences, what should or could be improved in your work?
Well, we would need a little push to be much better on harmonization and consistency. What prevents us from moving more and better in this area, which is important, is the lack of harmonized regulation. We have too many national options in the CRD4, CRR. My colleague Ignazio Angeloni, which is just in front of me right now, did a wonderful job to harmonize with a team from 19 countries, the ones that are in the hands of the supervisors, but we have still the national options that are in the hands of national legislators, and this is not harmonized, and it seems that the appetite of European legislators, now that they are changing CRD4, CRR, is not very big to address this issue, which is not a glamorous issue, but it is an important issue. We also have difficulties coming from the fact that too big part of the European regulation is coming from directives and not enough from regulation. And it means that directive has to be transposed into national laws, and there are still tendencies to transpose it in 19 different ways.
Still, yes, after 3 years.
Absolutely, still after 3 years. And even, I would say more curiously, there are still national legislators that take national laws for banks without taking into account the fact that we need to have a single rule book. And EBA is working hard to have this single rule book. So harmonized regulation is definitely very, very important, very crucial. To have these divergences cost a lot because we need to employ 19 different teams of lawyers. And it is not efficient. It's a pity that we cannot be more efficient with more harmonized regulation.
So lack of harmonization is one topic. And on the other hand, are you satisfied with the resilience of the European banking system?
Well, it has much improved. The European banks, the euro area banks, are in a much better shape than they were when we took over supervision in 2014. They have more capital, better quality capital. They have worked a lot to address their legacy issues, including the non-performing exposures.
But the work is not done, as Mario mentioned.
Well, obviously not, because at the end of last year, we had 900 billions of non-performing exposures in the euro area banks. So when you have a problem of this magnitude, obviously, you cannot fix it overnight, and it will take more than a year to fix it.
How many years do you need?
Difficult to say for the stock, but we have a guidance, qualitative guidance on how to address the stock, on how to address credit risks to reduce the risk of non-performing exposures. We have an addendum to this guidance about the quantitative expectations of provisioning for the steady state, for the new non-performing exposures. So we try to stop the building of future non-performing exposures. And for the legacy, well, the situations are very diverse. So it has to be only case by case assessment and solutions. We are working with all the banks that have too high levels of non-performing exposures. In the supervisory dialogue, they have submitted their own plans to address the issue. We challenge those plans to make sure they are ambitious enough and that they are credible enough as well. And to be credible, they have to be realistic. They cannot promise us miracles. Sure. Miracles happen.
You don't accept miracles.
So a lot is being done through this dialogue, and a lot of banks have made a significant effort. Some are lagging behind, so it's the work of the supervisors to push the late ones.
Looking at the non-performing loans, some banks are still very high. Would you say there are some banks that could be dangerous for the European banking system?
No, I will not say that because the weaknesses are more in the medium-sized banks or smaller banks among our significant banks. So it is important for each of these banks, and we will not relax the pressure on those banks, obviously, but I don't think it has a systemic dimension.
Do we need a European bad bank for that non-performing loans?
Well,
issue for you?
With the volume I mentioned, we can use all the tools that are available. And if there is a creation of European asset manager, as was proposed at a certain moment by EBA, that could be a good tool as well. All the available tools we'll have to use, provisioning, sales, and it starts even by changing the national regulatory framework. We spend a lot of time in a stocktake exercise of the national legal environment, the capacity of these national frameworks to address fast in courts when it is needed to be in court. The repossession of collateral, for example, for the secured loans, or for the possibility for the country to have a faster out-of-court solution, which is most of the time better for SMEs or for households, for mortgages, for example.
The hotspot for non-performing loans is still Italy. After Monte dei Paschi, two other regional banks have requested so-called precautionary recapitalization. Should such banks simply be wound up?
I don't think so. I think the banks have to stop denial when there is still denial, because we have made denial very difficult right now. So when the banks are not anymore in denial, they have to address their problems. And if they cannot address the problem on a standalone basis, there are possible mergers with bigger banks.
We don't
maybe.
See so many mergers,
we don't see. Well, we may be seeing some in the future. There were some mergers. For example, CaixaBank being more important in equity for BPI in Portugal, for example, and so on and so forth. So. Yeah, this is taking place. It's not big, spectacular ones, but there are efficient ones, and we are not looking for spectacular solutions, more efficient solutions.
With the beginning of the European banking supervision, many politicians promised that never again taxpayers' money will be needed to save a bank. Unfortunately, this is not the reality, as we know. Do you understand people's frustration with a European project? In that case?
Well, if they are frustrated because they believe that it doesn't go fast enough, I can tell you I am frustrated myself. Certain days I would like to do more and to go faster, so that I can understand. The fact that there is still use of public money, well, this is totally compliant with the legal framework. Precautionary recapitalization is part of the state aid rules and the BRRD framework. And sometimes they have in mind taxpayer money that was put in the liquidation of 2 Venetian banks. Well, this is fully compliant with the legal framework. There were no reason to resolve these banks at European level, no public interest in doing so. That was the assessment of the SRB, which I fully understand and support. Then they were liquidated according to national rules, and the national rules were permitting to have this public money. So if the legislators in Europe do not like that, they have to change the legal framework. They can't do that. Yeah. And as a matter of fact, I would suggest them to change the BRD, which is a directive, into a resolution, in regulation, not a resolution, a regulation. Not to have 19 different transpositions of the directive, because what is important for investors is certainty. If we have differences in the bailing order, for example, or certain definitions of the BRD in different countries, that will have a cost for European banks. So it would be great to have a regulation that is directly implemented in the same fashion by the single resolution mechanism instead of the directive transposed in 19 countries.
As a chair of a really important European institution, how much are you concerned about the rise of populism in Europe? How much are you infected maybe by that anti-European movements and environment with your work?
Well, as a citizen, I am very European-minded myself, so it's not just by chance that I am in a European job. And indeed, I am very, very concerned. I am not. It's not affecting my work in the fact that I work in a very strong, credible European institution. I have the best of two worlds. I have the expertise and experience of national supervisors in the different countries. On the distance in the decision-making process, we take decisions in this very solid, credible institution, which is the ECB at the European level, so with some distance from national pressure if they exist. So that's not affecting my job. But I have the strong feeling that we have to work very hard and very well to deliver on the expectations and be successful. Because
so there is a responsibility.
It's a responsibility. We have to. People have to feel that we act for public good and to serve better European citizens. That's the objective, and I think about it almost every day, to be honest.
What does Brexit mean for that, for your work and for the European project?
Well, Brexit is a very sad decision of UK citizens for a European-minded person. Yeah. It will change the context of the SSM and the responsibilities of the SSM, and we are meeting a number of banks. Around 50 banks have visited the ECB and the National Competent Authorities, sometimes several times, to discuss their relocalization plans. So they are improving their understanding of the situation. The SSM banks...
How many banks already applied for a bank license?
It's about 20, that have something already being assessed. Maybe they have not signed the formal requirement, but kind of pretty comprehensive application that can be turned into a formal one very, very, very fast. For the relocalized banks.
Yeah. What kind of reforms are necessary to strengthen the monetary union after the Brexit?
Well, I don't know. That's a bit beyond my territory. I think that all the people working for Europe and all the European-minded citizens have to make sure that Europe is successful, that we do our best to provide European solutions. Otherwise, I think we are, all countries in Europe, even the biggest one, pretty small compared to the big competitors coming from other regions of the world after the crisis.
Mm-hmm. And how important is that, because you're French-born, the French and German access to push new initiatives for Europe?
I think that's great, because well, I am old enough to have seen that Europe is progressing when France and Germany are working together to develop Europe. And I'm very happy to see that France is back with a strong European mind. And it's very welcome, because you mentioned populist, and they are too white in my country. That's a concern, really. So we have to, again, the French and the German together, we have to work well and to be successful in promoting more European mindedness among citizens. And for that, we have to demonstrate that we do a good job, and that we are successful in protecting their interests and making Europe stronger.
Yeah. Yeah, we already mentioned cross-border consolidation in Europe, and you said there are some small mergers in that case, but don't we need more and bigger steps on the consolidation of the European banking system?
Yes, we definitely need more. I think one of the next objectives for the SSM, now that we are in a quasi-steady state, even if we are a young institution, is to really forge European banking sector. For the time being, we still have different national banking sectors, in fact, growing together and coming together through banking union. We have to forge a European one. We have...
In which way?
In which way? Well, cross-border consolidation in particular. I think it's not the job of civil servants, quote-unquote technocrats in a tower, supervisors, to decide what is a good cross-border consolidation. But it's our job to make sure that we don't prevent it from happening by having certain elements that make it less likely or more complicated. In particular, I support very much, and we support the possibility of waivers that is introduced by the Commission, capital and liquidity waivers within European groups, when now it's much more locally only. And I understand as well that, well, some countries are not so convinced that this is the way forward. But I believe, yes, it's the way forward. In order to have a single jurisdiction on the European banking sector. And then I hope that thanks to the benefits of a better economic situation, the benefit of consistent supervision for European groups, the banks on the market will move and get the benefits of a single jurisdiction. They are there. They are very close, those benefits. So it's the moment to reap these benefits.
It is the moment, right? But the question is, what could the ECB banking solution do more to push cross-border mergers?
Again, make sure that we have not created impediments, or that we are not making it more complicated. And then when the markets, banks have decided what are the mergers that are making sense, our work will be to make sure that they are successful, those mergers. And in order to make them successful, we have to challenge the new business model for the new entity. And we have to be, I would say, not tough enough. It's not about being tough, but have good judgment to see where things could not go well if we are not cautious on demanding when the operation is starting. Because mergers are difficult operations, and they can be the best or the worst thing.
I will quote you in that case. Consolidation is absolutely necessary, you said, and the sooner it comes, the better. Do you expect mergers in the next 12 months, for example?
I would like to see them.
You're
yes.
not a glass ball,
Well, yes, I am an optimistic person, so yes, I expect them.
Okay. What would it mean for the too big to fail problem if it comes to pan-European mergers? Is it a problem for you?
I have never been convinced that size was that important for systemic risk, in fact. Yes. I think complexity, lack of resolvability of banking groups are problems to be addressed. But size is manageable. And now that we are 19 countries, much larger territory. It has changed also the assessment of what exactly is too big in such a big constitution, big jurisdiction, I should say, I guess.
So the European banking unit is not finished, as we all know, as a third pillar. A common deposit insurance is still missing. Do you understand the political debate and the political concerns on that topic?
I understand, but at the same time, we need to move. The countries that still have high level of non-performing exposures, for example, have to address the situation. And the other countries have to be brave enough to build Europe. I think it's the moment to do it, frankly. And let me remind you that with banking union, SSM and SRM, we have already significantly reduced risk, and we are reducing risk significantly. So both have to move in parallel, reduction of risk and increase of solidarity, but a lot has already been done. So I am very happy to see that the Commission is reopening the discussion that has been blocked for too long, in my view. It's a bit more gradual, okay for that, but we should not forget that the ultimate objective is to have same protection for all European depositors, whatever the country. Otherwise, it doesn't make much sense to have banking union.
Sure. There are a lot of challenges for the European banks, as we already mentioned, regulation, interest rates, and so on. On the other hand, the new US President Trump has already announced a clear deregulation of the financial sector in the US. When it comes to that lower regulation, what impact do you expect for the European banks?
Well, first of all, we should not.
You don't believe in that? What he's talking about Twitter?
I think it's not. Yes, that worrisome. At least not yet. I would say we should not fool ourselves. Flexible transpositions of Basel rule have always existed. They have existed also in Europe.
Yeah.
And sometimes we had implemented Basel rule in a flexible fashion for very good reasons, because the economies are not the same in the US and in Europe, but sometimes for less good reasons, really. It exists, and it exists everywhere. For the US, I would say that the jury is still out, really. I have discussed a lot around the meetings of the IMF with my colleagues in the US. And I see a wish for more simplicity, maybe to abandon the certain elements of Dodd-Franks that were a bit opaque, like the way of doing the stress tests in the US. That is not the way we do it with EBA right now. But I have not seen a desire to just forget about tough regulation and to go to pre-crisis times. So let's see what happens. The jury is still out.
Okay. By the way, are you following Trump on Twitter?
Not at all. I don't fully follow Twitter. I am old generation, you know. I am not in social networks, and
maybe you should to understand them better.
Newspapers instead of Twitter.
So you're reading Financial Times and Handelsblatt, yeah?
Yes.
Okay.
And other newspapers as well, not only. Yeah.
So last topic is digital revolution. How will that change the banking industry, in your opinion?
Well, competition of fintech is definitely one of the elements that are putting pressure on the profitability of the banks. It creates also a lot of opportunities for the banks. They can serve customers that would like to get their banking services through a telephone or a tablet more efficiently and less costly. That could help them to reduce their cost-to-income ratios that are far too high in certain banks, on average in Europe.
John Krein, the CEO of Deutsche Bank, said he expects a big number of people that will lose their jobs. He said, in our banks, we have people behaving like robots, doing mechanical things. Tomorrow, we are going to have robots behaving like people. Is he right? Was that?
I don't know. It may happen. I'm not so sure. The world is changing, but maybe not to that extent. Or maybe I am too...
You don't expect a real disruption by digital?
Well, it is changing the world pretty fast, and I see what you call a possible disruption. I see it every day doing my work. I can tell you if I receive an email and I have not responded in the next hour, people start to wondering whether I am sick or I disappeared somewhere. Yeah. So yes, I feel the pressure. The world is changing. It is changing our lives, but not to an extent that we cannot cope with those changes. Even an old person like myself is coping with this kind of changes so far. So.
But are banks changing fast enough their business models in that case?
Well, the banks are changing their business model, definitely. The profitability drivers and the profitability issue is largely triggering these changes. It's not fully final in Europe. They still have work to do. And in particular, draw the lessons of overcapacity of banking services in European countries. And it takes us back to this merger consolidation issue as well.
But what do you expect? Do you expect more investments in the IT infrastructure and in digital products and services?
Definitely, capacity to offer digital services to customers is almost everywhere now and will be everywhere. But what I would like to see is digitalization inside the banks, in fact, by plugging digital services to almost prehistorical IT systems sometimes, is not delivering the efficiency and the cost savings that could be delivered. So now the banks have to be digital internally. And I think it's like for NPLs on the good economic conditions, it's the right moment for the banks to do that. Because many of them recruited very large teams of employees in the 70s, people that were more or less my age. We enter into banks. That banks was taking a lot of the students in the end of the 60s and beginning of the 70s. So those people are retiring. So it's not even creating a social issue if they move in this direction.
Fintechs, we already mentioned, will there be partners or rivals for the traditional banks?
In my view, both. They may take part of the business and incomes of banks in certain areas, like payment services, for example. But they will need, in my view, probably the support of banks also to develop themselves. It's a little bit, in my view, like the development of hedge funds a few years ago, when the banks were regretting losing what they were calling wealth management. That was a profitable activity. And they lost a little bit of wealth management, but they developed a very profitable business, which was called prime brokerage, working for their competitors working for the hedge funds. Dangerous business that was well controlled and indirectly supervised by the bank supervisors, how they were dealing with these hedge funds. So I believe the same should happen regarding fintechs. And banks can also create their own fintechs. They can buy fintechs. That's part of the move that should take place.
The great financial crisis erupted 10 years ago. Do you see a new generation of bankers coming up? Less risk-driven, for example? Or maybe?
Well, indeed, I believe that everybody learned from the crisis, for sure, the supervisors, but the bankers as well.
Yes.
And I have seen in my previous life as a French supervisor that the French bankers were more cautious before the last crisis because they had the memory of the big crisis of the 90s in France. So I'm sure that bankers have not forgotten the lessons of the crisis. They are not doing some pretty risky, exotic derivatives activities that they were doing before. At the same time, we are all human beings, and there is a characteristics of human beings. They forget the lessons that they learned before. So there will be a moment where they might be less prudent. We see more leverage operations develop. Leverage finance is growing. I think the regulation has addressed large part of the problem. The governance rules are much better right now than they were before. Culture risk are better identified and mitigated. But
compensation is
harmonization.
Compensation systems are.
Oh, compensation systems are more under control for sure. I think more could be done to change the regulation in fit and proper for the board members or for senior managers. Fit and proper is a very old part of the directive, and it was conducted. Well, I don't remember, but decades. And it was under minimal harmonization. And when we have 167 national options under maximal harmonization of the CRD4 CRR, you can imagine what it means, minimal harmonization for fit and proper. So I think we need to have the harmonization, but we need to have the update as well of the national laws that transpose that part. Because in certain countries, for example, board members, we cannot declare unfit board members that have been condemned by courts once, two times, 3 times if there are a lot of possible recourse until the ultimate possibility of being clean is not exhausted. Until this moment, they are still in the boards of the banks. When in most other countries, thanks God, when a banker has been condemned for something that has something with his integrity capacities as a banker, even if it can be clean in the second step, we can ask these people to prepare their defense instead of still working in a board, or most of the time themselves decide that, okay, they work to clean their reputation first, get cleaned by the courts, because sometimes courts make mistakes, and they are, the decisions are reviewed at another level. But when you are obliged to wait until the ultimate decisions of the ultimate court to say to somebody, no, you are not fit for a board, well, there is a serious problem, frankly.
Okay. But in total, would you say the cultural change is more than a word?
Oh yes, it's more than a word, but we are not totally where we would like to be. There is the progress are diverse, let's say, and even among the best pupils, there is still room for improvement.
If you had a wish, what wish would it be? Would you like to be loved by bankers?
Oh, certainly not. It's
Certainly
a curious idea. I don't know whether, and I don't care whether they love me or not.
Okay.
As a supervisor, and I hope that, I believe it's the same for my colleagues, we aspire to be respected for hard work on sound judgment, and also for being adequately tough and totally fair in supervision. That's my aspiration, not to be loved, for sure.
Okay. Thank you very much for that open and inspiring conversation, Madame Nouy. Thank you.
Thank you.
Great.
Watch every day from 8:30 to 10 to get caught up and prepared for the trading day. I'm really excited about this panel. We are going to talk in a broad way about European financial integration, and I think it's a fascinating topic because there are a couple of myths about European financial integration that at least I, who have lived in New York for the past decade, have come to, in some ways, believe. One is that it's purely for political purposes. We are always told it's so that there won't be another world war here. I think there are, however, stronger economic underpinnings for the desire to integrate financially, and hopefully we can talk about that. One of the other myths about European financial integration that's more of kind of a kooky right-wing social media thing, but now that we're all exposed to that, we see it so much, is that European financial integration is a way for the Germans to kind of take over Europe again without firing a shot. It seems harsh, but a lot of people actually think about that as one of the flaws for integration. We'll talk about why that's not true, and hopefully we can get some discussion about the correct way to communicate financial integration, and then we'll decide how far we've come and how far we need to go. I'll introduce the panel here just very quickly. I'll just go starting with my neighbor here, Stefano Micossi, Director General of Assonime. It's a think tank focused on capital markets, corporate taxation, competition regulation. Also a professor, now an honorary professor at the College of Europe, and he taught there for many years and serves on a multitude of boards. And for businesses, for capital markets, for policy studies. He has headed the international research group at the Bank of Italy, and he was Director General for Industry at the European Communication. So he'll... Commission, sorry. And so he'll represent not only, you know, the national side of things perspective, but also the European perspective. Let's see, Elisa is right next to him. Elisa Ferreira, I didn't know the actual order when I put my notes together, but she is, of course, the Vice Governor of the Bank of Portugal. She also was a member of the European Parliament for a long time, 2004 to 2016. She served on the Economic and Monetary Affairs Committee there, among other things, and she was instrumental to key legislation that established the Single Resolution Mechanism and the Single Resolution Fund. So she's been a really key player in this, and she can talk about integration from the perspective of now a national central bank, as well as from a European legislative point of view. So particularly valuable. Maybe those two hats are sort of fight against each other once in a while. Then we have Sir Paul Tucker. He's a knight, which impresses me. But of course, he also was the Deputy Governor of the Bank of England. I think very interesting about Paul is that he's the one person here who's not, or soon to be not, European, right? Because he's British, they're leaving, and also he left Britain to go to the birthplace of the American Revolution, so they left there.
My wife is Belgian, I should say.
He is a professor, a fellow at Harvard Kennedy School, chair of the Systemic Risk Council there, and has served on a lot of integral boards, G20 boards, for example. So he has done a lot of work as far as integration is concerned. And it'll be really interesting to get his opinion. He's also a director at Swiss Re, among other things. So then we have Ignazio Angeloni right next to him, currently the ECB representative on the supervisory board of the SSM, the Single Supervisory Mechanism. I'm going to try and avoid acronyms as much as possible, but there's so many with SSM, SRB, BRRD, and I'm going to establish ground rules in a second so we can try and avoid that. He started work for the ECB in '98, then he went to the Bank of Italy, then in, I think, 2005, and then back to the ECB as an advisor to the executive board before taking over macroprudential policy and financial stability as Director General. And he's basically negotiated for the ECB to form the SSM, so very integral part of that as well. Then we have Jordi Gual next in, the chairman of CaixaBank since 2016, but he's been at CaixaBank for a long time. He served as the executive director of strategic planning, chief economist there, among other roles. He's also advised the European Commission in Brussels on economic and financial affairs, and he can contribute really from the valuable perspective of the supervised. I've heard a banker say the supervisory victim. So we'll get his perspective there. And then we have Dirk Schoenmaker, professor of banking and finance at the Rotterdam School of Management. He's also a senior fellow at the think tank Bruegel. He's written a number of books about these things, and I think it's great to get someone from Bruegel because not only as a watcher, but also as a judge of how these institutions are doing. Some of the ground rules I just wanted to, hopefully we don't all speak as long as I just spoke because we have only an hour and a half. Hopefully we can avoid all of the acronyms because there's so many, and if we want to communicate this to the public in a way that's non-threatening, it helps to just not, play alphabet soup the entire time. And I encourage you all to please intervene. So if you, for example, Elisa, disagree with something that Ignazio says, jump in and don't feel rude about it to make this a conversation. Why don't we start with Paul? I'd love to get your take, first of all, on the importance of financial integration in Europe. Why are we doing this? We're all behind this, I guess, and probably everyone on this panel is for it. Why should we be pushing for this broader European financial integration?
For two reasons. First of all, let me say it's a real delight to be here. Is the microphone now?
Yeah, now it's working.
Okay. It's a real delight to be here. Thank you very much to you and Danielle for inviting me. I think it's my 4th time at a conference in the ECB this year, but my first time ever at a conference about supervision, and I think that's a terrific thing, essentially for 2 reasons. Because resources will be allocated more efficiently in Europe if there is a healthy, integrated financial market, which will help to make the people better off. And most of all, and this is why the Capital Markets Union project is so important, is that it helps to transfer risk. Now, those sound quite abstract, but what we have at the moment is a monetary union without the necessary financial and economic structure behind it. And this makes the people of Europe less well off than they could be, and the whole project a lot more precarious than it could be. I hugely welcomed the creation of the SSM, and I hugely welcomed Danielle's appointment as chair for 2 reasons. It's hard in many of the capitals of continental Europe, which are quite small towns, for the supervisors not to be captured even where they are good people and good professionals. And there has been a problem of capture of bank supervisors across our continent for a very long time, and it's extremely hard for people in office to talk about it, and it is quite easy for people like me who are not in office, have that behind us, to talk about it. The second thing, it's tremendously important that the SSM be led by somebody for whom, if I can presume, it is their last job, so that and that, as you were speaking, Danielle, in responding to the question, do you aspire to be loved or liked by bankers? And what I heard, and what I wanted to hear was, no, I aspire to serve and be respected by the people. And you're only free to do that if it is your last job, whether you're the governor of the central bank or the head of supervision. And I think the SSM can hugely, in slow motion, change the integration of financial markets. We'll talk about it later. I'm concerned by the nature of the national presence on the SSM board, where I think still reflects a degree of capture, but overall I think this is good for integration of financial markets in Europe, and I think that matters enormously for the welfare of the people.
Let's talk about that now, the nature of the national presence on the SSM. Should that Dirk, let me ask you, because I know that you think the national presence in the individual resolutions that we've seen recently has been too strong. And what do you think about the national presence on the SSM?
Let me first, thank you. Let me first start with 2 observations. I think supervision has done a lot. And last year with Nicolas Ferron, I looked at the first 18 months of the ECB, and they did a lot. But what we see is that integration has not been improving. And then I come to the national one, because if you look at cross-border flows, I looked from 2014, so cross-border flows between banks, you can measure it on the aggregate level and on the individual level, bank by bank. It's the same conclusion, it is flat. And you would have expected an increase because of the integration of banking union. And I think, although the ECB is doing a great job and the harmonization project has been with a lot of vigor, I think there are still two captains on the ship. So if you have a subsidiary, you have a local license, and then the national supervisor where you are, even if it's inside the banking union, can ask for capital, liquidity, and you mentioned waivers, but national people cannot really spell that word, so they don't use the waivers. And I think it is not only about rules, it is really about two captains on the ship. Because there are two schools of thought. We can solve it by more harmonization. I think we can only solve it by getting one captain less on the ship. So make it truly European and having European decisions and get the nationals out of the equation, because we have a single jurisdiction now in the euro area. That's very controversial, but so I think it is really, we need one captain, not two captains on the ship.
I want to also, I want to hear from Jordi as someone who's, chairman of a national bank, and also from Elisa, who has an opinion on waivers as well. She can spell it, I'm sure, but I don't think she's for it. First, let me ask Jordi about the flows.
No, I wanted to go back to the issue, and is related to the issue of integration. I mean, we economists know from many years, it's already well known, that integration is on net good. There are welfare gains to cross-border financial services and to the freedom of establishment. But we also know that whenever you have opening up an integration of previously isolated or autarkic markets, there are winners and losers. So we know there are redistributional problems. And this is true in other industries and also in financial services. So it is not at all surprising that in the process of European banking integration, we observe huge resistance from national member states. Now, whether it's, unless we have additional political integration, it's very hard to get one single captain. And the same happens with regard to the other argument that favors European integration. We want to have financial integration in order to better distribute financial risks in the marketplace. That is true, but citizens in Europe would like to see, quite often, not only private redistribution of risk, but also some degree of public redistribution of risk. And that is missing. So it is not surprising that it is hard to get the ship going, because there is no agreement between the overall the single jurisdiction and the national jurisdictions. And the national jurisdictions, and I'm sure Elisa has a view on that, have the national politicians and the national jurisdictions, the national regulators, have, of course, a local constituency with preferences which may not be exactly the ones that correspond to the single union, to the whole union. And it is hard to move forward integration on this basis.
But all right, then let me get Elisa's take before we get to Ignazio's response, because you have a national constituency, but you also served on the European Parliament and are obviously incredibly pro-Europe. So how do you balance those things?
I have been and I am. But first of all, let me just leave a note of compliment for this discussion, because I think it's important that we discuss a project that is very complex and that we have moments where we discuss what we have to fine-tune eventually. And I think we have got to fine-tune a lot of things. Secondly, let me praise, because now I'm part of the board, and I am proud to be part of the board, the work done by Danièle, by Sabine, and by all the staff, because in 3 years we did an immense amount of work. But having said this, I agree that we should ideally have one captain. But one captain is a captain for the good times and for the bad times. What we have in Europe is not a banking union, is half of a banking union. Banking union has 3 pillars, we just have 2. And this is like a cake half-baked. Yep. A half-baked cake can be really, really very bad for your health. So, okay, I agree, and I was listening to Danièle, and she knows what I think about it. She was praising the mergers, and the merger of, and the consolidation of BPI in CaixaBank. And I speak here with under the control of my good friend Jordi Gual. Yes, nevertheless, God forbid, but if anything would go wrong with CaixaBank, if you had to wind out the bank, just imagine, God forbid that. But okay, let's put in theory. Let's put in theory. Because we faced Popular. I mean, we saw what would happen. What has happened? In the case of Popular, you have the supervision is done at the level of SSM. The resolution is decided at the level of the resolution board. But then if it happens that you have to, you go into a wind-down situation and you have to pay for the guarantee of deposits, then you have a bill that you send to the Portuguese taxpayer, and you had nothing to say, or you had very little to say. There is no proportion between your capacity to decide and your responsibilities and liabilities. So before we have this alignment of liabilities and responsibilities at the European level, we cannot think that a national supervisor can be comfortable with a subsidiary that operates in your country, that even if it is a small one, like in the Popular case, but in practical terms, the covered deposits amounted for 2.2 billion, which for a small sovereign is not easy. In the case of CaixaBank, BPI has more than 12 billion of covered deposits, and it is absolutely unacceptable that you have this mismatch.
I feel he very much a catch-22. Because when I speak to my German and my Dutch friends is, well, we cannot have European deposit insurance as long as we have the national features.
They should have said it before.
Yeah, and you say as long as we have or not you, but in general, as long as we have the national features, we cannot have European deposit insurance. So we will never get there. Because
okay, but then we cannot have waivers on capital. We cannot have waivers on liquidity. Yeah. We cannot have a complete centralized way of addressing the supervision and resolution. We have got to live with the present situation. Yeah. That's the life we have. Yeah. So we are stuck. We are stuck in the middle. We have got to move. Yeah. But we cannot pretend that being stuck, that we have a full thing. Yeah. And the other element is that at this stage, I'm sorry to address this, but when we talk about NPLs, we are in a competitive world in which a considerable number of banks that managed the NPLs through bailouts before 2013, the banking communication of August 2013, and then the BRRD, so they did it before, so they are now fresh, run and kicking, competing with others that could not, for several reasons, do it or didn't do it, and now we are, so the way you manage the new legislation is another element that comes with this half of the bridge situation. So unless we move forward, and here I would make a caveat saying I don't see the common deposit guarantee as a risk-sharing issue. I see it as a risk reduction issue. Because if you don't have it, the way you have managed BRRD with 8% minimum bail-in, you are bound to trigger a bank run at any moment. And then resolution becomes much more expensive. So I think we need to go to fine-tune this situation, but we cannot have the best of both worlds. That's the question.
Ignazio, how do you respond to that? I mean, these are issues that you grapple with on a daily basis, obviously.
First of all, Matt, thank you very much for helping us in this debate. I'm hearing a lot of skeptical voices. We are stuck, no progress. Let me speak on behalf of the glass that is half full. We need to understand what we are after. What is financial integration? To me, concretely, financial integration is law of one prices, same conditions for lenders and borrowers and savers roughly everywhere in the area, once you adjust for risk, obviously. But also risks have to converge, otherwise prices are very confusing. So law of one price and a sufficient amount of cross-border business happening. Why do I say sufficient? You don't necessarily need to have, in all segments of the markets, people investing and lending in one country or the other. Certain markets are inherently local. I mean, a Portuguese saver can deposit its funds in Latvia. Most likely he will not do that, but not because he cannot do that, because it's not practical to do it. So what did we see after we have to look at the last 15 years or so. So we see after the euro, we see the huge, quick, massive integration of money markets almost immediately. Interbank markets, I mean, the cross-border ratio of this is about 50%. So it's huge. It's massive there as well. Deposit market, which is normally local, if you calculate the ratio of cross-border to total, you take an average over the area, is about 26, 27%. This is huge if you think of it. About half of it is within the euro area. The rest is from outside of the euro area, which is a good thing as well, because it means people from outside the euro area depositing their funds in euros in European banks. The lending market is a little bit less. The retail lending market is about 10%. So, but that's sufficient, because when markets are potentially contested, it means that competition exists anyway, even without a mass of cross-border flows. You have an integrated market. So this has been, I think, this has been achieved. Largely, there's progress to be made, but that definitely, I mean, if we look at the relative to 20 years ago, there's been a massive change. What is difficult to sell, I find, is the message, is the communication side of it. The ECB has been engaged for a number of years. We have a data set, we publish a report and all this, but it's a very difficult message to sell. Because, first of all, European banking integration, so you have Europe and banks. There's a lot of skepticism nowadays about both notions, Europe and banks. So you have to overcome that. Plus, it's a technical thing. You have to explain the benefits. But the benefits are real. So I think all of us, I take it on me, also the ECB, to the extent that this is not effective yet, enough to make an additional effort to explain to the people, to the public, to the politicians, the huge benefits that the common citizens have been able to obtain.
By the way, in your report, there's a great graphic that shows sort of the advancement of European financial integration over time. And it initially grew quickly and has since, over the last couple of years, as we see this kind of political turmoil as well as populist decentralization movement, it's slowed down. Stefano, we were talking about this at dinner last night. Why do you think that there's been this big anti-Europe sentiment, this anti-integration sentiment, this sort of move back to populism? And why has that slowed down financial integration as well?
Yeah, there are peculiar features in the monetary union that we have that explain why a major variable in determining financial integration indicators, as you have in the report by excellent reports by the ECB, reasons why integration depends on political instability. Meaning by political instability that when you have increasing doubts on the future of the Union, you see indicators of integration receding. This is what you have. And there is a paradox here. Some people say, before we proceed, we have to clean out all the legacies and have a perfectly balanced system country by country, then we can integrate. What we observe, the paradox is that as long as there is political uncertainty on the future of the Union, the markets will not tend to integrate. The kind of good integration as defined in the ECB reports that we want, that is equity markets, long-term debt markets, credit markets, and retail banking integration, recedes when there is political instability. But the integration of those markets is what makes the monetary union resilient, because you have a lot of private risk sharing. Now, political instability, this is the paradox, pushes back private risk sharing, meaning, as Elisa just said, that we fall back into a system in which, in the end, if there is a shock, you will need public bailouts. So we should recognize this fact to understand that we must move forward by removing this kind of political instability before we can proceed. And the Commission, in the latest EDIS proposal, has done just that, because they say, okay, let's forget losses sharing, let's forget insurance, joint insurance of risk. Let's just do one thing. Let's start the system with a liquidity line that will prevent liquidity shocks from destabilizing the monetary union. And this is their first phase. Notice, we are transferring anyway the power of control to a European authority, so the objection of moral hazard is garbage. It doesn't stand. And once you have this,
although it's quite often voiced.
I know, but it is not analytically and technically founded. And one of these days we have to sit down and show that some of these arguments have no foundation. And then, once we have this liquidity line and we remove the political risk from banking union, then we can work hard on NPLs, on sovereign risk reduction, which is already happening, but without the continuing threat that political instability will break the system. And we can discuss how to do it.
This ties with something which I believe it's very important. Financial markets all over the world need reference prices. In particular, a key price is the risk-free asset. Okay, the price of a risk-free asset, it's a benchmark. And we have built a monetary union where we don't have such a price. Well, there is one, which is the German Bund. Of course, for obvious reasons, we haven't been able to advance in the construction of a properly shared risk-free asset. So
well, because having a national risk-free asset doesn't work for the entire European Union.
Well, countries which are not Germany, and in particular, of course, countries in the periphery or in the south, have lost access to the risk-free asset, and this has tremendous consequences. Now, if we want to ensure that our system is not subject to political instability, we have to continue on building that risk-free asset, which is, to a degree, shared by all member states which belong to the Eurozone.
Eurobond.
Otherwise, well, there are several innovative proposals out there, proposals that take into account the legacy issue, and it's important because the legacy affects the structure of the banking systems and the NPLs, but we should move forward. Otherwise, when we get to the new stage where quantitative easing is gone to a degree, the current mirage, the idea that now we see stability will be gone, and the possibility of another shock to the system, it's crystal clear. To me, when people ask me what keeps you awake at night, I say this. What keeps me awake is that we have CaixaBank is a bank within the Eurozone. It's run with euros, and the potential of another 2012, it's extremely dangerous for such a bank.
Can I make one proposal as a step in between? Because I think Stefano started with liquidity as step one. I would say there is now also momentum for step two between France and Germany to reform the ESM to a proper European monetary fund. Because if you do liquidity, you need a solvency backstop. And then we can start with European deposit insurance, debt restructuring, and then only at the final stage, we can think of Eurobonds, but I would really...
Let me just, your microphone dropped. You can...
Yeah, I would really argue that in addition to liquidity, that we take now the momentum to reform the European Stability Mechanism as a backstop to the banking system and for sovereign debt restructuring, and then we make clear that there is only one captain in Luxembourg, that it's quite clear that if there is a crisis, because I agree with Elisa, we need to keep them for good and bad times. So only when we solve the bailout issue and the backup, and the better you have organized it, that's a lesson from theory, the less you need it. That's the great news. So it is more the organizing it, like the OMT. We are not using it, but given that it's there, it creates confidence.
Paul?
So there's something slightly too abstract about this. So for me, the single best indicator that there has been a problem with financial integration is that something should have happened and it didn't. What should have happened and would have happened in a completely integrated market is that the strong banks of the north would have opened branches in the countries with weak banking systems in the south. And you would have expected them to do that because they would have absolutely cleaned up, because you would have taken your money out of the local banks and put them in the branches of German banks or wherever. And why wouldn't you do that if you were running one of these banks? You wouldn't do that, and you hinted at this, but actually you said it, but abstractly rather than concretely. It's because you would worry that the country in which you'd opened a branch might leave the monetary union. And in the circumstances in which the country leaves the monetary union, your local assets are likely to redenominate into local currency assets and get impaired because of the recessionary hit. Whereas your liabilities, you are going to have to stand behind, denominated in euro. And if you think about the complexion of, say, the Polish banking system or the Mexican banking system, those are probably the two best examples, and some of us are old enough to remember this, what happened when their crises occurred in the 80s and 90s. Foreign banks moved in because they were safer. And it is this goes to your concern about deposit insurance. It is but it's always cast, this debate is always cast in terms of banking. And the blunt truth is, there is a single monetary policy, but there is not a monetary union. Most of the money we all carry around or use are the deposits we hold with banks. There are 20 monies within the European Monetary Union. There is the money that Mario issues, the notes, but that's inconvenient to carry about. Most of the money we use are deposits held in 19 national banking systems. And I will try to refrain from naming a country, but you could think of big countries and you say, if I hold my deposit there for a while, am I absolutely certain to get €1 back? No, you are. Well, actually, what you're going to get back is €1 times the probability that the deposit insurance scheme and the state behind it will be able to stand behind that €1. And is that probability 100% everywhere? Absolutely no, it is not. And once you start thinking about it like that actually we haven't got one money, we've got 20 monies, the questions about banking union and monetary union and risk transfer through some kind of catastrophe unemployment insurance system, and Eurobonds perhaps, all of these are joined up. And there is a risk today, and there's nothing much that the SSM can do about this other than get on with its work. There is a risk today that because growth has come back, thank God, that people want to push these issues to the margins. This is based on, there are still flaky foundations, and a recession will come again. And Mario and his successor have much less in the tank. And even if they had things in the tank, the underlying fragilities will eventually engulf us. And my country may not be in Europe, but believe me, if it engulfs continental Europe, my country would be washed into the middle of the Atlantic Ocean.
I just want to also point out, sometimes if a country risks leaving the monetary union, the bank actually leaves that country,
Yes.
Or if a region risks, the bank could move out, as we've seen recently. But I want to hear Stefano's response to that, because you brought up this point.
Yes, and to take the point one step further still, the reason that makes the monetary union such a peculiar construction, the monetary union that you have, is that we have one money administered in Frankfurt and several fiscal and economic policies. And because of that, no one country controls the currency, but they can run divergent policies. And so the simple result of this is that investors will never be sure that the common money will be available to support the sovereign markets or individual countries in case of a shock. And this is what makes this peculiar construction always potentially unstable until you cannot provide the guarantee that joint provision of liquidity will always be available. At that time, to the banking system, at that time the banks become, you don't have anymore the redenomination risk, and you get one tie, the banks become the same thing. Now, the question has been, how can we do this without, you know, taking up the risk of these damn Southerners with all their legacies? And the way it is now proposed to do it is, let's start EDIS, so we give the message to investors, but only with the liquidity line. Risk sharing will start later under the control of a European authority. And only when the European authority, so conditional on approval by European authority, when we come to that point, after another asset quality review, legacy risks will be assessed and probably by that time gone. So we can play the game of risk sharing. And here you have extra delicate, super delicate problems on the role of the European Stability Mechanism. And the simple thing is that the liquidity lines must come from the ESM. Where else? That therefore becomes the neutral fiscal backstop. Why neutral? Because losses we will leave to fall on national insurance systems until the second and third phase. So there will be no losses from the banks thrown on to the other members of the liquidity support scheme under this approach, which is now the Commission approach. Everybody has said the Commission is backing up. They are now only proposing a liquidity line. But this line of liquidity is the key to take off the table the redenomination risk. Then we can play many other games without the fear that the sky will fall on us.
It's insufficient. A liquidity line cannot be enough.
Cannot solve solvency issues.
No, it can't.
Yes.
Because I think this is absolutely crucial. What Stefano has said, and that connects with what was said before. That we have got to. I think we did the most difficult part of the process of banking union, because we did common supervision, common resolution with the entities, and they are running and all this. So my appeal is that we are completely aware of where we stand, and that we don't dream that we can do things for which the counterpart is not yet there. But of course, all the progress into the finishing of banking union is welcome. But until we get there, the danger is that by imposing excessive MREL on all the banks, you accelerate the process of consolidation, not through the market, but through the regulatory angle. And this is absolutely contradictory with what we are doing. By being too demanding on cleaning up the NPLs, you may create really a fire sale in the market, because you are not sensitive to the constraints under which you are operating. And here, just for
we're already at fire sale, right? I mean, we're hearing about assets that are going for 13 cents on the dollar, so there can't be any more fire sale than that.
Okay, so what will be the consequence of that? I mean, even for the collateral inside the bank. So if we really want to create this kind through the regulatory angle, if we want to create this stress on certain banks, and I'm sorry, I make here another caveat, being completely aligned with the general picture that you have drawn, Paul. But please, when you talk about the strong banks of the North, don't forget that now you can say that, but the strong banks of the North were massive, bailed out before 2013, and that it was them who created most of the crisis through excessive exposure to the financial market.
Can I just ask Ignazio, aren't we, though, still much better off now than we were? I mean, Jordi's, what keeps him up at night is that another crisis happens like in 2012. But in 2012, you got on the ball, created the SSM and the SRM, and aren't we now much better off than we were then?
First of all, this panel sounds more and more like a heated discussion in a bar, which was not intended, but I think is very good. You know,
What's wrong about the bar?
Very good.
That was exactly my intention.
I thought that was the purpose of it.
No, 2 points I wanted to make. First of all, on Paul, I agree that cross-border branching and subsidiary opening is a very important indicator, and to some extent we are not there yet. But even there, glass half full. French presence in Italy is very large. Spanish presence in Portugal and elsewhere growing. Italy and Germany bilaterally. So these things are happening. And as the banking system is restructured, also in the small and medium size segments, this is happening more and more. So again, we want to proceed more, but I think this is happening to some extent. Now, in terms of the basket of things to do, I mean, this is already quite full. I mean, things to do that have been signaled by panel members are piling up. But two things I wanted to, in addition to EDIS, deposit insurance, Stefano, and also the point of completing legislation and making legislation more homogeneous. That's the point that Danièle mentioned earlier this morning. There are two other things, in my view. One is the single resolution framework. We have a very good regulation. We have an authority. They're working, but there are things missing. Not so much in terms of instruments. They have the instruments formally, but the funding of the Single Resolution Board is very, very weak. There's no backstop, and the fund is building up slowly. So at the moment, we are still not in a position in which the Single Resolution Board can be effective. So we need to work on that. And the other aspect that I would like to raise, not often mentioned, is the competition authority. As the market integrates, you have more competition across borders. So you need a stronger, in parallel, you need a strong competition authority to guard, because you have more possibility of large players coming in and more competition risk. Now, we do have a competition authority in Europe, which is quite strong and very active in a number of sectors, including banking. So far, they've been largely concentrated on state aid control, which is important. State aid control, historically, has been very important. It's still important. But as we build, in banking, I'm talking, as we build European authorities, there's much less scope for states to prop up national banks using supervision and a number of other things. So I would expect the state aid component of the general competition control framework to become gradually less important, and the market competition control to become more and more important. And so I would expect, and I would hope, that the competition control arm, gradually shifts its focus less on the state aid control and more on competition control, because that's very important as a complement of banking integration.
I would like to express, to continue the VAR conversation, to express a bit of this dissenting view on the issue of observing integration of European banking through branch opening and entering into new markets, at least for the kind of business that CaixaBank is at, which is retail banking. Retail banking, to me, Ignazio, is one of the examples of a market where the natural markets are relatively small. There are barriers to geographical expansion. Among others, you need a substantial market share wherever you are in order to be profitable, and having an important brand name doesn't help you unless you have a significant market share in the market. Given the fragmentation of resolution and deposit insurance, the funding and equity or liquidity funding advantages of being in many markets are not there. The scale economies are exhausted pretty soon. You face many jurisdictions with different legal, commercial law, insolvency law, and others. So that adds complexity and removes advantages of size. So we are not observing large increases in cross-border activity in retail banking, small ones like the one at CaixaBank and BPI in a neighboring country, which is for good reason. To me, I wouldn't expect this happening. It is unclear also that we want at the European level this to happen, because then you have banks which may be too large to fail. They might be diversified geographically, but who knows? There is a recent study that shows that the investors may prefer to play that diversification, investing in different local players which are strong. So I would like to put a note of caution on this goal of achieving cross-border mergers.
But I mean, one of the things I was thinking of, though, when Ignazio originally said that, if, you know, when I was younger, you got paid for depositing your money into a bank. There were interest payments on those deposits. And I would definitely invest my savings in a, did you say Estonia? Estonian bank?
Latvia?
Latvian bank, if I got a better interest rate than I did here, except for the fact that the things that you mentioned are very important. I don't know how the resolution laws work there. I don't know.
Ask Iceland.
Exactly.
But can I make one comparison to the US? Because when the interstate restrictions were lifted, then we got the super regionals, and then quite soon they became nationwide banks. Like, for example, Bank of America started from San Francisco and is now one of the biggest US banks. And that's the big thing we don't see yet happening in Europe, because in the US they had the Fed. More importantly, they had the FDIC. Then you, of course, did a really nice that's comparison with Nevada and Ireland. And so, as a counterfactual, it is possible. So there, the barriers were taken away. And I think what SSM is here doing is a great job. So they are fulfilling that precondition. If we take the other ones also to the federal level, then we can get the Bank of Americas in Europe. And I think that will happen at some point.
Which not all national governments would like.
But
and so there's opposition to this.
Yeah. But that is exactly the point, the crucial point in this, because it all started when we started banking union. We had this vision of bringing more, basically more stability to the financial market and cutting away the link between sovereigns and banks. That triggered the whole thing. So when we looked at an inspiration model, that the American case was there. But the Americans started by granting stability to the market and trust. That's why the origin of the thing was the FDIC, Federal Deposit Insurance Company. So that then the other banks could play hard and become, but then the basic trust of citizens in banks was guaranteed through that.
But the states in the US also have a different fiscal regime from the sovereign states.
Of course.
Well, I think both of your points are...
But that is the crux of the thing. You in the FDIC and in the American case, you have a credit, an open credit line, quite robust, into the Fed. Whereas here we started by by risk control, and we are still saying risk control, whether at the same time, and here I agree with the proposal proposed by Danièle, saying, okay, we have got to transform BRRD into a regulation, but probably we have got to check if it is adequate, independently of the business model, to ask for 8% bail-in before you can intervene in the bank or do even precautionary cap. Because with 8%, you cut away not only in junior debt, but senior debt and even deposits. So the propensity for instability with this legislation, and the revision will take place, I think, next year, because there was a review clause because of the doubts. You cannot use the resolution fund because of the 5%, and you have got to bail in independently of the business model. So I think we need to have more clarity on the vision that we want to have for the European banking system. Because if we just go for cross-border mergers without any limit, then you are killing diversity. You are creating what, 50 big banks in 15 years, and did we control actually the too big to fail? So I think it is what we have reached is sufficiently important for us to go on deepening the thing, but we cannot do it without understanding where we are.
Well, I think all of these comments kind of come back to Stefano's point, which is that you can't have total, obviously, financial integration if you don't have national integration into almost a federal European system. You've got to have the political will there before you can get the financial, reach the financial goals that you want to. But the interesting thing, I think, about the ECB, what I've noticed as a reporter over the last years covering this, is that the ECB has the independence and the agility to move more quickly than the Commission, and oftentimes leads Europe in a way. And Ignazio, I want to ask you about if that's intended. Is that a goal that you say, listen, we're going to go ahead and do this work, and then try and bring everyone else along?
No, there's no doubt that financial integration has been for many years among the strategic goals of the ECB.
But then you bring sort of a federal Europe along, politically.
That may happen. I mean, we don't have either the potential nor the mandate for bringing Europe along with us. I mean, there is a legislature, there is an executive, there are many other things. But certainly, you are right. The agility is key, and the importance of our mandate as monetary policy maker, which historically brought many things along. I think that gives the potential. I think that gives the potential. But let me. I think one conclusion that is emerging here is that the main obstacle to more integration is the multiple links that still exist between banks and their national governments. Multiple links. There are regulatory links, legislative links, financial links, both ways. Banks rely on governments still largely for their support. And the state relies on banks for its funding. So this brings to the picture the question of holdings of sovereign bonds in banks. And this is an issue that is very delicate, because we know that sovereigns are very important in the financial sector, so you want to touch them with a good deal of care. But it is a fact that these exposures have created big segmentation shocks in the last 10 years or so after the crisis. And so from a prudential point of view, and also from a more general point of view of stability of the euro area, we need to think about that issue. We need to approach that issue. I know that there are different views. I know this is delicate, but it cannot be an element which is absent from the discussion.
Stefano?
Yes. First of all, I don't think we should let the important statement that you made, Jordi, on the fact that there are no good reasons for integration of banking markets. I'm not a banker, and I'm not sure about the answer. But while I take your argument about the difficulty of integrating by conquering markets, starting from a national base, I think we should look more closely at the experience of cross-border banks that exist. One is UniCredit, and Jean-Pierre Moustier today is with us. And I think the story there is different. At least in principle, this kind of integration, M&A, and there is a report in the ECB, there is a chapter in the ECB report on financial integration showing how this activity has basically come to a halt for a number of reasons, but which are not all physiological. Again, the issue should be looked at. But the question is this. Cross-border retail banking integration may become one major element of cross-border private risk sharing. So if it is not viable, I think we have a problem. If we see the future of this construction with nationally separated banking system, we have a problem. The lingering instability danger. So I think this is a question that we have to examine again. I'm not sure that I'm ready to share your conclusion. I'm not sure I have sufficient element not to share your conclusion. But I think this is an important element to which we should pay attention.
Well, I'm starting to get some comments and questions from the audience, and one of them I think is pertinent to this. And someone's pointing out the important issue is to decide what clients of these banks need. Do they need domestic banks? Do they need international, pan-European banks? And clearly a mix. I mean, you have experience with these. No, surely clients that need you to be in other markets.
But I mean, one thing is to have international presence and to follow your client when they are abroad. The other is to have local franchises established in the different parts of the union. I fully admit that there are banks which have cross-border presence. That cross-border presence was built in previous times. We have to go back to the issue of technology and the way we provide services nowadays. Does it make sense today to develop branch networks overseas as compared to what happened in the 80s or in the 90s or in the 2000s? So the things have changed, and a bank that today wants to expand internationally probably has to think about the digital dimension as opposed to doing it physically. Doing it by taking over other banks is, of course, a possibility, but there some stability on the regulatory front would be most welcome, because with uncertainty about the capital requirements, it's also a hard proposition. I wanted to also make a very general statement on the issue of the question of the ECB promoting further integration. I think that at the European level, we have already for too many years gone ahead with integration through the back door, so to speak. And banking, and we've seen it in this discussion, this is a business where further integration, like B of A moving all across the United States, cannot be separated from additional political integration because of the differences with insurance schemes, resolution schemes, commercial law, insolvency law, you name it. And if we try to push banking integration through the back door, this backfires through populism and opposition to the idea of European Union and unelected officials moving ahead with the agenda. And this ties with the other issue, and I'm sorry, Ignazio, you mentioned the issue of sovereign risk in the balance sheets of banks. I understand that having sovereign risk in the balance of banks facilitates domestic treasuries funding. I fully understand that. But again, this is a legacy issue. Once again, the countries that joined the monetary union and the banks that were working in those countries had a risk-free asset. That risk-free asset is gone. Should we change this on the regulatory grounds? No, until we have an alternative.
Well, yes.
And again, it's a political issue.
Yes, because they're risky.
But again, this is a political issue. It's risky, but it's exogenous.
It's an issue of monetary economics.
But Paul, when it was in our books, it was not risky. With monetary union, it becomes risky.
No, exactly. And so if something goes from being not risky to being risky because of monetary union, it's better to face up to that. I think this discussion, by the way, is not making a distinction between branches and subsidiaries. I've been 4 years out of office, and so I may have forgotten.
No, you're right.
But I think that a deposit with a branch is insured by its home country.
Yeah.
And the point I was making earlier is the indicator of lack of integration is that the strong banks, well, banks from strong countries, like the one we're sitting in, haven't branched into other countries. And we should think deeply about why wouldn't they do that? Because they could build scale really quickly, because what people want, customers want all sorts of things, but what the deposit customers in a bank want most of all is to get their money back when they want it. And you are going to get your money back when you want it from the branch of a German bank, because Germany's got a massive external surplus and a relatively low debt to GDP. And that is not true of other banks, of other countries. And so the indicator that we should be concerned about is why haven't German banks cleaned up, because their bosses could all be and their shareholders could be richer, they've got massive incentives to do so, unless branching is actually a risky thing. And it is a risky thing, because actually, as you say, I think you and I are in the same, more or less the same place, because of the residual risk that those member states will leave the monetary union and they will have euro-denominated liabilities and local currency depreciating assets. And this is an elephant in the room, which those of you that are constructing Europe, need to face up to. Can I say one other thing about NPLs? Am I allowed to do that?
Yes, I had a question for you as well from the audience.
One number on it, because I check it always. You see a slide increase in branches compared to subsidiaries within the euro area, so it's going very slow.
Yeah.
And let's look at the big example of Nordea. They moved from subs to branch because they were fed up with all the local issues. So I think the market can take the hand by themselves. So it is happening a little bit.
Tiny.
Tiny.
Absolutely.
Very little.
Tiny.
Yeah.
The position, I think the position you adopt on NPLs is absolutely fascinating because it's it's rational locally and it's extremely dangerous for the collective, and you now have national incentives. So, the NPLs policy is a lot better than it was, but it's not great. And I watched your speeches. I watched about 2 years ago, pretty tough speech. Mario gives a speech, slightly softer. You give another speech, harder than Mario's, slightly softer than your first. And I was sitting in Harvard and I almost wept. And the problem is that if you don't have, it doesn't have to be fiscal union. Now let me make another step first. So the fact that we're not dealing with NPLs is one of the reasons why these banks are trading at a huge discount, apparent discount to assets, and that's because the market knows that the assets are not worth what they're shown as in the books. This is a terrible place to be. But if you don't have any kind of catastrophe fiscal safety net, dealing with the NPLs, facing up to the fact that lots of these banks are still very badly impaired, could tip the local economy into a recession, a massive, in economic terms, a massive asymmetric economic shock for which there is no collective insurance. And so where you were sitting, where you were before, you had incentives to we must deal with NPLs and we need some kind of fiscal transfer system. Where you are sitting now, and we've known each other very many years, you have incentives to say, my God, no, we can't do that because I'll tip the local economy into recession and there will be no transfer of resources. And let me tell you, investors, if everybody in this room disagrees with that, this is what every investor from outside the euro area of any significance thinks, because it is obvious that there are banks around this continent stuffed full of assets that are worth hugely less, sadly, than their book value. And I think you are doing the very best you can, constrained, and I applaud you for it.
This is a true.
You are.
May I?
Please, yes.
Yes. I think you have a point. The problem is that I'm not saying that it is black or white. I think banks, and banks are aware of that, they need to get rid of NPLs. That goes without, there is no question about that. What is the timing? Is it 2 years? Is it 5 years? Are you supposed in 2 years to assume imparities for the stock, or just for the new loans, or for the ones that materialize? So it's the fine-tuning I'm asking about. I didn't move from one situation to the other. I think I still have the same vision that I had. I still trust there are ways in which we can evolve from the ESM into a European Monetary Fund that can actually create the backstop that was foreseen since the beginning in relation to the Single Resolution Fund that was foreseen since the beginning. Also, since the beginning, there were elements of stability that were taken at the European level. And the crucial thing now is that we miss these elements for stabilization of the financial sector. We don't have them at the European level. If you find one, you tell me.
I'm agreeing with you about that.
Yeah, there is none. There is none. So the crucial and the critical thing is if you consolidate the banking sector, not through the market normal mechanisms, but rather through regulatory pressure. And so if you do it through regulatory pressure, you are bound to trigger a crisis. And the instruments that we have to manage a failing bank, they don't bring stability, they bring instability. Even in that sense, if you look at the state aid framework, they ask for a private contribution, but they don't go into senior debt. In the United States, you don't see senior debt in danger, even less depositors. So if you have this legislation as it is, if we are not prepared to move it and to change it and to adapt it in order that we have certain elements for stabilization of the financial sector, we cannot go that far that quick, because that's my argument. So I'm very, very faithful to our common project, but we have got to be very wise and very objective where we stand at this moment, and that's the basis of my argument. So let's evolve, but let's evolve. And the proposals that were presented by the papers by Bruegel, for instance, in relation to the evolution, to create an ESM that tackles at the same time I'm not saying that I agree with everything that is written there, but there are strong ideas that build on our common compromises in the past. I mean, they have got to be brought forward, because some of the work that is being done now by ESM and by the SRM, they don't produce the stabilization impact that we wanted them to, just because we miss pieces. We miss a revision of BRRD, we miss the stabilization elements of the backstop and a minimum progress on EDIS. And of course, we have a monetary union that is not complete. But it's not easy for the common citizen to understand exactly what we mean by this. But if their deposits are in danger,
Let's talk about
savings are in danger,
they will understand.
that they will understand very,
Let's
very
talk
well.
about that. Let's talk about just the completion of banking union, because I'm getting a lot of questions from the audience on this subject. One of the questions I think we've already kind of answered, but we did it quickly. Are any idiosyncratic shocks manageable by means of the liquidity lines?
No.
Is this sufficient to control the redenomination risk? And you both have said no, I believe, already.
And I said it's a beginning.
But it is a beginning.
I said it is a beginning. We announced that we are establishing the full system, but we start with the liquidity line. This takes away the risk of a liquidity shock. You can only do one thing at a time. To proceed to risk sharing, we will need more risk reduction, because today we are not ready for that. And this is the key point. So my liquidity line is a bridge. It's not the solution. But we need this bridge to move forward, because otherwise we are stuck, as you said.
The political tragedy here is that liquidity lines of that kind, which I agree are a step forward, or indeed the Target 2 system, which is an intraday liquidity line, or the ECB operations, are presented as not being immune from the German and other objection to resource transfers. But of course, they are contingent resource transfers. That's what a loan is, because people can. And I feel very depressed, and I felt depressed about this for years, that no German politician will explain to the German people that, of course, there is a resource transfer system. And the monetary union would have cracked apart into smithereens. It is a contingent resource transfer system. And I actually think there is a moral duty on politicians to explain to their respective publics how the system works. And the reason this matters, the reason the moral point comes in, is that if ever there is an absolutely gigantic default and the ECB's capital has to be rebuilt, Germany and other countries will have to chip up the most. And then people will say, well, why is that? And the answer is, well, because you gave them loads of money that you didn't get back. And it would have been much better politically to be open about it, in my view.
You tell us.
But we must also recognize what I call the paradox. In the system that you have today with fragmented market, you have much less private risk sharing through capital markets and credit markets, and so much greater risk for what you just described.
Oh, equity markets are the key to that.
So if we reduce the risk of redenomination and move forward, we will have greater integration of private markets and greater risk sharing building through private markets. So we are exactly doing what our German friends would love, but they are blocking this progress.
Let me ask Ignazio a related question that we get from the audience as well. What we're talking about here is different Europes running at different speeds. Someone asked, what will a Europe of 2 or more speeds mean for financial integration? Is that completely unacceptable to you? Is that not within the way? Is that not part of the framework of your thinking in the SSM? And the question continues: can you imagine an EDIS, which is a common guaranteed insurance deposit insurance, for a small group of euro area countries? Ignazio.
I'm expressing my own views here. I think the idea of multiple speed Europe is already in the facts, and it is increasingly in the facts. I mean, we have lived for many years with the Commission giving us an objective in terms of European Union integration, so including the countries that belong to the euro area and including the countries that don't belong to the euro area. Now, with the recent developments after the crisis and with Brexit, I think this is gone. I mean, the main project is clearly the Eurozone. Now, the question whether we should have multiple speeds in the Eurozone, I think that's not possible. I mean, the fact that there is a single currency brings everything else together. Otherwise, the disequilibrium is too strong. Yeah. So there we have the big project that this is what we are talking about.
The whole panel agrees on that.
The issue we are confronted with is the fact that in order to build a truly resilient Eurozone, as we have seen in this debate, we need further political integration, and we face the resistance of non-Eurozone countries. One of them was Britain.
No,
Britain is gone.
We were very keen on further
integration.
Yes, we were.
Not on Eurozone. Not on Eurozone. Eurozone integration.
Yes.
Well, it didn't look this way.
I've been present when our former Prime Minister has talked to other Prime Ministers about it. We were extremely keen for further deepening of the euro area for many, many years.
All right, that's a
I'm surprised to hear that, but
no. The British government, successive British governments. It is not in the UK's interests for the euro area to be fragile because it is next door to us. And we made absolutely clear at the most senior politically level many years ago that we favoured much deeper integration, even though that would create a massive power on our doorstep that would be uncomfortable in other ways. That is absolutely. What you say is just not right.
Okay, I'm not going to argue on this, but we face now the opposition of other countries, certainly Poland, to give an example.
That's true.
Although I may be also opposed on that by someone at the audience, and the Swedes are not that happy, I understand. So that would be, to me, a critical point. To what extent is the European Union allowing the two-speed to go ahead?
Well, someone just says, how can you talk about EDIS, the deposit scheme, without recognizing the real problem, the unlimited coverage of German deposit insurance?
Oh, the small savings banks. And yeah, I think in the end, there are two issues on the two-speed, because one issue on the two-speed is significant and the less significant banks. And if we go ahead, because I think the good news is when the SSM regulation was designed, of course, we have to split significant and insignificant banks. But when it really matters, like a license, or you do a merger, or you do an exit, and it's like going to church. You nowadays only go to church for being baptized and marriage and when you die, and not every Sunday anymore. But at these moments, they go to the ECB. So that's very important. Then there is no distinction between significant and less significant banks. And in that sense, I'm strong in favor that EDIS would apply to all banks, significant and insignificant. And in that way, you would get rid of that certain local are promising full amount, but I've never heard who's behind these local reinsurance schemes. On paper, they are self-reinforcing, like a group of savings or cooperatives, but who's behind it? That question is not answered. And by doing properly EDIS with the ESM or a refined ESM in the European Monetary Fund behind it, makes the Eurozone extremely stable on the banking front. Because the better you have organized it, the less often you have to use it. And then we get rid of the, on paper, unlimited insurance, but just the 100,000 for all euro areas.
By the way, I think church going is probably a little different in Holland than it is in Spain or Portugal.
Okay,
so
yeah, okay, sorry.
There's still not.
I'm ahead of the game.
There's no European church integration yet.
Yeah.
Please.
You are suggesting. I didn't completely understand what you were saying that. Less significant banks should create a sort of IPS across in other countries so that you have this kind of private or voluntary contribution and you don't trigger BRRD? Or
no, I propose that the less significant banks also become part of EDIS. So we should get rid of the private...
But they don't have to get rid of the IPS, of the private. That's something that goes on top?
Makes it clear and just have one scheme, because all these intermediate schemes and these private schemes are not helpful in the discussion.
Yes, but it helps them not to have bailed-in, massive bail-in when they get into trouble, and that's the crucial thing. And that's the reason why small banks are in trouble. If they get in trouble, they become systemic, because most of them they don't have bail-inables. I mean, they don't have junior debt, and so they.
But most small banks can be resolved through a standard purchase and assumption technique, where you transfer the deposits and whatever assets are good to another.
So you are saying that the MREL and BRRD should not apply to them?
The directive added ambitious components to the G20 plan that I chaired the group that produced.
So what you mean is that BRRD and MREL should not apply to small banks?
I didn't put it as strongly as that.
That's the obvious conclusion from.
We're doing a horrible job at avoiding the acronyms, and I'm guilty of that as well.
Oh, sorry.
No, it's okay. I think we're all right with SSM and SRM, and EDIS I think is skirting, but we get a little bit. BRRD maybe is a little too much. Now I have one that even I don't get. Someone says, rather than, and Paul, I'll put this question to you because you kind of brought this up. Rather than wait for banks to venture beyond home markets, why not focus on creating products like a commonly insured European ISA? I'm not sure what ISA is. Is anyone?
I think, so this is an investment. Go on. No, go on.
So, I mean, Microphone. You've got one currency but 20 different forms of money, but rather than look for banks to provide the solution for that by venturing out of their home markets, why not perhaps look what you can do from a more consumer-focused point of view, so offer a common European savings product that all banks could offer, but is commonly insured, or perhaps do something like create a credit passport, for instance, that people could have their financial data on and use it to access services throughout Europe, because it's very difficult to go and open a bank account in Latvia or to open an account in Spain, whereas if you had something common that you could just carry with you in your purse or your wallet, I think that would help integration in a way that would be very obvious to people.
So I think it's important to distinguish in this debate about deposits, money, from the other services. The other services all matter, but they don't have this kind of existential element that kind of banking collapses can bring about. And on that, the first thing you said, it would be a kind of Trojan horse, of course, but we're all in favor of Trojan horses. A kind of ISA type thing that was mutualized. If that was a way in to that. I mean, in a sense, I can say this because I'm not in office. Those of you that are need to find a way for Germany to back out of a policy that is not actually in the interests of the German people over the medium to long run. And people no one likes losing face. And so they're not going to pop up and say, oh, by the way, we didn't analyze our own interests correctly, and so we'd like to change course. The kind of thing that you describe, and maybe other things that have similar characteristics, are a way of, in slow motion, kind of changing the trajectory. My response to this goes to our debate. The debate between you and I really is about the pros and cons of forbearance. And forbearance, in a normal monetary fiscal union, forbearance is a really, really stupid thing. And I've seen people do it. It's not a completely stupid thing in the circumstances in which many European countries, Euro area member states, find themselves. But it is still a gamble, that part of forbearance doesn't go away. And so if forbearance is the default strategy, it is immensely important that at the same time that you're trying to find these Trojan horses that can lead you to a more secure place. Because the risk is that growth will not raise the boats up, and actually you will end up with a horrible economic downturn a few years hence. And the people will say, this project just does not serve our interests. Whereas, of course, it can serve their interests. It is only because it is poorly designed that it doesn't serve their interests. And that it is poorly designed is not their fault, for God's sake. It is the fault of the elite.
I want to get back quickly to the cross-border discussion as far as bank consolidation is concerned, and just ask you again, Jordi. I mean, Madame Nouy said she's optimistic that we're going to start seeing real cross-border consolidation in 12 months. That was, I think, a very optimistic statement from her. She's left now. So do you actually see that happening? Does it make any sense to you? I'm not asking if Caixa looks at other targets outside of the Iberian Peninsula, but does it make sense?
I have to say I don't see it happening in a strong way in the coming 18 months. I see that part of the case for cross-border mergers is still not there because of all the political restrictions that I just mentioned. I have to say that we went through an M&A, a cross-border M&A that Madame Nouy mentioned, and we acquired BPI. It took us 2.5 years to finalize the operation because of voting caps and whatnot. I mean, the market for corporate control at the Eurozone level, it's still not an integrated market, and there are, as I said before, domestic legislations and rules which prevent the easy access, the easy acquisition of interesting targets. It took us 2.5 years, and we had been in that bank for 15 years with a substantial share of the bank, 44%, in fact, during the latest years. So it is hard. I think that one of the
and yet we hear reports of, for example, BNP Paribas or UniCredit being interested in Commerzbank.
Newspapers publish lots of things, right? So you know about that. So there are rumors, and there might be rumors. Now, what I want to say is that we've heard this issue, and the central bank has said this repeatedly, and the supervisor also, that Europe is overbanked. Now, one way to reduce the size of the industry and to extract synergies and to reduce branches and to reduce employees and to increase efficiency is to avoid overlaying of branches and employees, and therefore domestic restructuring, even if from the point of view of integration we don't see it as making progress. It actually makes progress in terms of reducing NPLs and increasing the efficiency of banking systems. And that's what I see happening. Now, moving to this beyond to the second stage and getting to the B of A, I think it will happen when we have additional political integration that solves some of the issues that we see with resolution.
You need the political drive.
And it will take a few years. And by that time, I doubt it will be through conventional banking, because many of us will be working not in banking institutions, but in what I call sometimes platform banking.
You'll be working for John Cryon's robot teams. Let me get back also to the NPL issue, Paul, because you brought this up earlier. Someone in the audience points out a price to book value at Barclays of 0.5, at RBS of 0.6, at Standard Point Chartered of 0.6. Are they insufficiently impaired?
So it would be really nice
These are not
if people identified themselves. But so actually, I think there I chose my words carefully as well. I said it's one of two main reasons why you can get a discount to book. The other reason, of course, is a business model that doesn't generate earnings, or in at least one of those banks, they effectively have impaired assets through the kind of litigation overhang. But were you to point out, all the UK banks are in a mess too, that doesn't invalidate what I said about it's kind of, cheap shot.
No one signed the question here. Just getting these little.
No, that's. I was hoping someone would raise their hand, which is the normal. Kind of more used to that, really.
Why don't we? I think we've pretty much come to the conclusion that the political will needs to be there for further financial integration. Ignazio, do you think that's the case, and do you see it coming, or what are your hopes, say, for the next 2-3 years of your work?
2 or 3 years is more difficult. I was going to say it's really in the cards in the very long run. I mean, this continent is too integrated in so many ways that the only strategic direction that makes sense is to rationalize and integrate all the rest. Now, it can be very bumpy in the process, but that's where certainly supervision is moving in that direction, and politicians are, I think, hopefully increasingly convinced, and that's the way to go.
And in the meantime, please be careful. that's my word.
I would add here that the window of opportunity seems to be there now.
Yeah. Exactly.
If Macron can really find an interlocutor. Now, if we don't do it before the end of this legislature, I think we are in for big bumps.
Exactly.
Very likely.
And don't wait for the next recession.
We will go through then not only the next recession, but the end of QE.
Yeah, exactly.
And other developments. So, yes, in the long run, there is no alternative, but I think the game should be played in the coming 6 months.
Exactly, and that's exactly what happened last time, because the SRM, there was some difficulty about how to build a resolution fund, and in the end, Parliament got a lot of power against Germany to make it, because it was the end of the legislation. And that time, a good deal was made, because we complained it is too slow, but it would have been slower without that deal. So I think the end of the legislative area, that is the time to because then Parliament is away, nothing happens afterwards. So that can help.
Another thing that people, I think, have not fully realized, that the project is to integrate deposit insurance and resolution, and to build the European financial, what is the name of FDIC? Federal Deposit Insurance Corporation. So it's one authority under which we want to bring all controls, one authority that is already established, that has shown its teeth in handling the first resolution exercises. And I keep on repeating this because people seem to overlook. We are talking of bringing the matter under the control of an established European authority. We are not talking of leaving free hands to the rotten banks of Southern Europe. And this point keeps on being overlooked. There is no moral hazard because there is no open risk implicit in this transfer of powers, because every single decision of intervention by the EDIS will be taken by this European authority. I don't think it's a secondary aspect, but people seem to overlook. Institutions matter.
Excellent. I fully agree.
The bottom line is, I think that we've just established the glass is more than half full because of the tireless work of Elisa, of Ignazio, of Danièle, of Sabina, and that we need to seize the day in order to fill it up. So thank you very much for the panel. I think it was a pleasure. Thank you. Thank you.